Hi there. If you own commercial property in the UK, there's a little-known indexation allowance strategy that could significantly reduce capital gains tax in 2026.
If you own commercial property here in the UK, you're going to want to pay very close attention. The next few minutes could genuinely save you a life-changing amount of money. And no, that's not an exaggeration. There's a really powerful but often forgotten tax strategy that most people just don't know exists. And understanding it right now as we're heading towards 2026 is absolutely critical. So let's get straight to it. Now, before we dive in, I want to be clear that everything we're about to cover has been put together by the expert tax advisors at My Tax Accountant. They're one of the UK's most trusted firms. So rest assured, the information you're getting comes from the very best in the business, and it's designed specifically for UK property owners just like you. Let's start with a number. Just look at that. £539,280. Now, that's not a lottery win. No, that is the potential capital gains tax bill that an individual could be hit with if they sold a commercial property in January 2026. Just imagine for a second. You're a shop owner in Manchester. Maybe you bought your premises back in the mid-90s. You've worked your socks off for 30 years, and you're finally ready to retire. This is the tax bill that could land right on your doorstep. It's a staggering figure, and for so many people, it's a total shock that threatens to wipe out a massive chunk of their retirement fund. But what if I told you there was a perfectly legal HMRC-approved way to slash that bill? A method that could chop it down by more than a third, just by holding that exact same property inside a limited company. I know, it sounds almost too good to be true, doesn't it? But it's real, and it's built right into our tax system. You can think of it as a relic, a sort of ghost of a past tax rule that smart companies can still take advantage of today, if you know where to look. So here's our game plan. We'll start by looking at the tax squeeze that's coming for property owners in 2026. Then we'll uncover that forgotten advantage that companies have, and we'll unlock the power of something called the Indexation Allowance. We'll see it in action with a real-world example, talk about a crucial deadline you really can't afford to miss, and then finish up with the practical steps you can take. Right, first up, the 2026 tax squeeze. You know, the environment for individual property owners is just getting tougher and tougher, and it's so important to understand why the tide is turning against personal ownership. What's really happening here is a sort of perfect storm of different tax pressures all hitting at once. First off, the tax-free capital gains allowance has been absolutely hammered, slashed right down to just £3,000. And that catches a lot of people out. But the biggest hit, especially for long-term owners, is that as an individual, you get zero relief for inflation. You're taxed on the entire paper profit, even the part that's just 30 years of prices going up. Did you know the value of the pound has more than halved since 1995? Well, as an individual, you pay tax on all of that inflationary gain. You add on top of that CGT rates of up to 24%, rising income tax on rental profits, and new caps on inheritance tax reliefs. Well, the picture becomes very clear. Personal ownership is getting squeezed, and it's getting squeezed hard. But this is where the story pivots, because hidden away inside a corporate structure is a forgotten advantage. It's almost like a secret backdoor in the tax system that lets companies play by a completely different set of rules. And this slide just lays it out perfectly. On the left, you've got the individual owner. They pay tax on everything. The real growth and the inflationary gain are treated exactly the same. But on the right, the limited company gets to use a special relief. This relief effectively strips out a huge chunk of that historical inflation before any tax is even calculated. So the key takeaway is this: the company pays tax on a much smaller, much more real profit. It's the difference between being taxed on reality versus being taxed on an illusion created by decades of inflation. And that special relief is called the Indexation Allowance. Honestly, the best way to think about it is as an official discount from HMRC, but it's just for companies. It was designed on a really fair principle, that you should only be taxed on your real gain, not the bit that's just the cost of living going up. It lets a company legally increase the original purchase price of an asset to account for all the inflation between when it was bought and December 2017. This bumps up your cost base, which in turn dramatically cuts your taxable gain. It's that simple and it's that powerful. Now, you might have heard that this allowance was frozen, and it was, but this is a really key point, so stick with me here. Frozen does not mean gone. For any property your company bought before 2018, that frozen value is still there. It's like money in the bank, just waiting for you to use it. The story of why this opportunity even exists is pretty telling, actually. This timeline really explains why this corporate advantage is a thing. See, back in '82, the government introduced the allowance for everyone, agreeing it was only fair to tax real gains. But then, in 2008, boom, it was completely scrapped for individuals. Companies, though, got to keep it, probably to encourage business investment. Then in 2018, it was frozen for companies. Now that didn't get rid of it, it just drew a line in the sand. It locked in all the inflationary relief that had built up to December 2017. And that locked-in value is the secret that we can unlock today. So how do you work it out? Well, conceptually, it's pretty straightforward. First, you take your original cost, and you add any big improvements you made before 2018. Then, you look up the official inflation factor from the Retail Prices Index for the period from when you bought it up to December 2017. You multiply the cost by that factor to get something called an indexed rise, and this amount is then added to your original cost, creating a much, much higher base cost to put against your sale price. A simple bit of maths with a huge impact. Okay, theory is one thing, but let's see what this actually looks like with some real numbers. We're going to run through a very realistic case study for a sale that's happening in January 2026. You'll definitely want to see this. Okay, let's just walk through this nice and slow. Both the individual and the company buy an office block for £1 million back in 1995. And they both sell it in 2026 for net proceeds of $3.45 million. Now, this is where it gets interesting. Take a look at the taxable gain. For the individual, it's the full £2.25 million profit. But for the company, after applying that indexation allowance for all the inflation between 95 and 2017, the taxable gain absolutely plummets to under $1.4 million. The allowance has just wiped nearly £900,000 of paper profit straight off the table. And that final tax bill, well, it shows the difference dramatically. The individual is facing that shocking £539,000 bill, while the company's corporation tax bill is just under £345,000. And when you see it laid out like this, visually, the difference is just so stark. That huge chunk of the bar on the left is pure tax that the corporate owner simply does not have to pay. It's the same property, the same deal, but a vastly different outcome, all because of the ownership structure. This just shows you the real, tangible power of getting your planning right. And there it is, the bottom line, a tax saving of almost £195,000. That is a life-changing amount of money. Just think what a business could do with that. That could fund a new expansion, you could hire 3 or 4 new members of staff, or it could just be a huge boost to a director's pension pot. It's all capital that's been preserved, simply by using a relief that's already built into the tax code for companies. Now, this strategy is incredibly powerful on its own, but there's another factor that makes planning right now absolutely critical. It isn't just about the structure, it's also about timing. And that brings us to the deadline of April 2026. Okay, let's talk about another piece of this puzzle. Business Asset Disposal Relief, or BADR as it's known. This is a crucial relief that lets many owners pay a much lower rate of tax when they sell their business or its assets, like a commercial property. It's designed to reward entrepreneurs. For years, that reward was a very nice 10% tax rate, but that window of opportunity is closing. The rate has already gone up to 14%, and it's scheduled to rise again to 18% in April 2026. So the crucial point is that the cost of cashing in your chips is going up, which puts real pressure on making smart decisions right now. So here's a pro tip from the experts at My Tax Accountant. For some owners, it could be a very smart move to deliberately trigger a sale or a transfer of an asset before that April 2026 deadline. It's a clever tactic. It might mean selling the property from one of your companies to another. You'd crystallize the gain now and pay the tax on it, a gain that's reduced by indexation, of course, but you'd lock in today's lower tax rates. This then creates a new, much higher base cost for that property, shielding all of its future growth from being taxed at those higher rates down the line. It's like pressing pause on your future tax bill. So, with all of this on the table, what should you actually be doing right now? Let's turn all this powerful information into a clear action plan so you can start building a more tax-resilient property portfolio. Here's a clear 5-step plan. First, audit your portfolio. You need to dig out the paperwork for every commercial property you or your company bought before January 2018 and work out the potential indexation value that's locked inside it. Second, evaluate your timing. Are you thinking of selling in the next few years? Could bringing that date forward to before April 2026 save you a serious amount of tax? Third, structure. If you hold property personally, now is the time to seriously review whether it should be moved into a limited company. Fourth, optimize. The indexation allowance can be combined with other reliefs like capital allowances for even bigger savings. And finally, plan. With all the changes to inheritance tax, you really need to reassess your entire succession strategy. If you take just one thing away today, please let it be this. In the tax environment of 2026 and beyond, being proactive about the timing and structure of your property portfolio isn't just a nice to have for big companies. It is absolutely fundamental to preserving your capital and your legacy. Now, it's really important for me to say that the information we've covered today is for general guidance. Tax is complicated and it's highly specific to your own personal and business situation. So please don't see this as a substitute for getting professional advice that's tailored directly to you and your portfolio. So, to find out exactly how this strategy could work for your property portfolio, the best next step is to speak to an expert. Get in touch with a team at My Tax Accountant using the details you can see on the screen. They can give you the bespoke advice you need to navigate these changes with confidence. Thanks for your time. And don't forget to subscribe to the My Tax Accountant channel for more vital insights just like this one.